Alright guys, so in this section of the series we are going to be putting it all together and including risk management features as well. This is a full breakdown that brings together everything we have covered so far in terms of the processes and important elements in practice, from top-down analysis, zone marking, referencing historical levels, identifying LTAs, and walking through a complete trade setup with proper risk management. If you have been following along, this is where the pieces start to click together. We begin this full breakdown by going through the top-down directional analysis process using the exact method we covered in the market direction video. On screen, we start with a 4-panel visual as each segment represents one time frame respectively: weekly, daily, 4-hour and 30-minute. This view helps us stack bias clearly from the higher time frames down to the entry level. We first zoom into the weekly chart, focusing on the two most recent candles. According to our rule set, the previous weekly candle is bearish, and the current one is bearish too. With no sign of shift or indecision, we mark this chart as bearish overall. Back on the 4-panel view, we stamp a red downward arrow beside the weekly chart. Now we zoom into the daily chart, and using the CCC method, we mark out two important zones: a significant low point and a clear resistance level where price recently stalled. You will notice that price climbed up from the low, tapped that major resistance, and immediately failed to break above. The candles here begin to stall, and we get a minor cluster of indecision forming. This is key. It is a classic rejection setup. Price pushes into resistance, loses momentum, and starts to roll over. So based on both the structure and this rejection behaviour, we confirm the daily bias is bearish. We zoom back out to the 4-panel layout, and now the daily segment is labelled with a red downward arrow too. Now we move into the 4-hour time frame. Our method reveals a clearly defined structure with a significant low and the most recent price action favouring the bears, and another red arrow is added. Finally, we move into the 30-minute chart, and support and resistance zones are drawn using CCC. Again, the structure is clearly bearish, and we zoom back out, and now all 4 segments are complete. Zooming back out to the 4-panel view, we now have a red arrow beside every single time frame: weekly, daily, 4-hour and 30-minute. This is what we call a 4-to-0 directional flow alignment, where all 4 charts point in the same direction. It is a high confidence setup, what we refer to as a full stack bearish scenario. We zoom into the 30-minute chart and draw in our key support and resistance zones. This gives us the structure we are working within. I've added a horizontal ray tool to pinpoint the next process of what's to come. This is where we begin identifying potential low traffic areas, or LTAs, within past data. Our goal now is to scan for historical price data that aligns with our current zone, specifically areas where price moved cleanly in the past, as these LTAs help us anticipate where momentum could accelerate if the level breaks. With our support and resistance levels in place and an LTA zone starting to form, we are preparing to map out the exact entry, targets and risk zone for this short setup. We scroll back through the chart's history to highlight 5 key reactions at our current support level. These 5 touch points explain exactly why price is pausing here at our current area. They each mark a major structural reaction in the past, and every point is circled here to visually reinforce its significance and clarity. Then we draw in a second horizontal ray just below, marking another key area where we can see 3 strong historical rejections. These 2 levels together form a clear historical zone, and within this zone we can start identifying 4 LTAs, or otherwise stretches of price action where movement was clean, sharp and low in traffic. We mark the top and bottom of the range itself, followed by a 3rd horizontal level right through the middle, where each LTA has a tendency to stall. This gives us a clear structured 3-level zone to work with, and while it may look narrow visually, a quick measurement confirms it contains 76 pips of range, more than enough space for a clean short setup. Now we zoom forward back to current price. With our green trading zone drawn between the historical levels, we mark this as our potential trade setup. We see price consolidating inside the zone, followed by a doji candle identifying indecision, and then a large red candle follows this, being our directional catalyst. This signals the potential beginning of the move, as then a second large red candle breaks and closes below the major support. The green trading zone is now active. At this point, we simulate a short trade using a position size calculator for demonstration purposes. Our account currency is set to GBP as this is my currency, and we are trading the GBP JPY pair or pound yen. The account balance is set to £10,000 for simplicity, and we have chosen to risk 1.5% of that amount on this trade. We should try to aim to only risk between 1 to 2% of our account per trade, but this is situation dependent. That means we are risking £150 because 1.5% of 10,000 equals 150 exactly. Nice and easy. We then enter the trade specifics. Our entry price is set at 191.758 and the stop loss is placed at 192.408. This gives us a stop distance of 65 pips. Based on this input, the calculator tells us our optimal position size is 0.46 lots. This means if price were to go directly from our entry point to our stop loss without any scaling out, the maximum possible loss would be £150. But in real application, we rarely take the full loss. This is where smart trade management comes in. If price begins to move against us, we scale out gradually, closing partial portions of the trade as it moves deeper into the stop loss range. For example, we might close 25% of the position if price moves a quarter of the way into our stop range, then close another 50% halfway through, and so on. That way, even if the stop loss is fully hit, our actual loss would be significantly reduced, potentially half or even less of the original £150 risk. This approach is a huge part of disciplined risk management as it helps protect your capital, minimises drawdown and gives you flexibility in fast-moving markets. To do this properly, you will need a reliable position size calculator, either from your broker or available free online, and a platform or tool that lets you scale out manually or with preset partial closures such as MetaTrader 4 or 5. Most trading platforms now support this feature, or you can use trade management scripts or expert advisors if you are automating. Switching back to the chart, we simulate the short entry in real time. Price drops directly into the zone and quickly hits our first target level. At this point, we follow through on our risk management plan by scaling out of 50% of the position. This means we close half of the trade and secure partial profits, reducing our exposure. Immediately after, we adjust our stop loss to break even, the original entry price, so that if the market reverses, the rest of the position exits at zero loss. As price continues to fall, we actively trail our stop loss to lock in further gains. This means instead of keeping the stop loss at break even, we adjust it closer behind the price action as the trade moves in our favour, effectively protecting more and more of the profit we have already secured. In this case, price drops significantly toward our final zone, and just as momentum slows down, a strong green candle forms and reverses sharply. This reversal candle ends up triggering our trailing stop loss, which secures the remaining 50% of the position right near the target zone. Without using a trailing stop, this reversal would have wiped out a large portion of our floating profit. But by locking in gains dynamically as price moved, the trade closes out as a clean win. Fully managed from start to finish with zero exposure left behind. To close out the video, we draw in fresh support and resistance zones based on the latest price action. This is something you should always do at the end of a session or trade, because price action evolves, and with it your structure needs to evolve too. Every trade setup is different, and by remarking zones based on new movements, you are allowing the chart to remain relevant and readable. You will notice how different this scene feels visually compared to where we started. What was once an empty zone has now developed into a new range with key reaction points, and your job as a trader is to always stay synced with that progression. Keeping your chart clean and current sets the stage for the next trade idea to emerge.